any other country, growth of 7% per annum would be spectacular. But even if achieved, it might not be sufficient to provide strong stimulus to the rest of the world economy. At this point, I want to argue that China's development model, based on the very rapid growth of exports to the developed world, driven in part by a persistently undervalued exchange rate, is almost certainly no longer sustainable. Before I explain more fully what I mean by that, I want to put my comment in the context of the factors which, in my opinion, drove the global financial crisis. It's, of course, fashionable to blame the global financial crisis on the greed of avaricious bankers, especially American avaricious bankers, and the gross incompetence of those regulators who are supposed to be policing them. Since I'm a director, as David Wilkinson pointed out, of the largest bank in New Zealand, I should declare an interest, lest you think my comments are a defense of bankers. There is certainly some outrageously irresponsible behaviour on the part of some bankers, motivated by what motivates most people in the market economy, the opportunity to make a lot of money. But I believe there are a great many other causes of the financial meltdown which began in the US in late 2007. There was, for example, strong political pressure on US banks to lend to uncreditworthy and marginally creditworthy borrowers. That was not a new phenomenon in the US, but the latest episode dates back to the early 1990s. Over most of the last 20 years, governments of both major political parties in the US encouraged banks to lend to borrowers who really should not have been able to borrow at all. And then we have the curious American habit of non-recourse lending, whereby borrowers engaged in a heads I win, tails the bank loses game, knowing that if house prices rose, the borrower stood to make a lot of money, or if they fell, the bank stood to lose a lot of money. I've been told that this non-recourse lending is in fact mandated by legislation in many American states. While non-recourse lending in itself doesn't create major difficulty if it's priced appropriately, it certainly seems to likely to have added some additional risk to the US banking system. And what certainly added very considerable risk to the financial system was the widespread practice of securitizing residential and other loans. What was seen by some observers as a powerful innovation enabling credit risk to be diffused across a multitude of financial institutions turned out to be the source of enormous danger. Loan originators had little incentive to ensure borrowers are creditworthy because they had no intention of holding on to the risk. They passed that risk on down the chain, with successive financial institutions clipping the ticket as the risk was passed from hand to hand, but holding no exposure to the potential default. There was no transparency or accountability in the credit chain, and significant parts of the process were largely unregulated. Another major source of the recent difficulties was the practice in many urban areas, in several English-speaking countries as well as the US, of tightly regulating the supply of residential land. Once demand for residential property started to go up, there was little scope or no scope for an increase in supply to meet that demand, and house prices started to rise strongly. But house prices hardly rose at all in a large and fast-growing city like Dallas, where restrictions on the supply of land were almost non-existent. They rose very strongly indeed in places like Los Angeles and San Francisco. As Thomas Sowell has noted, 60% of all mortgage defaults in the US are concentrated in just 5 states, primarily those where the supply of residential land was subject to tight restriction. I also want to put at least some of the blame for the global financial crisis on banking regulation and supervision. And I'm not arguing that the crisis wouldn't have happened if bank regulators had been more assertive or more attentive, but rather that banking regulation itself may have contributed to the crisis by leading both depositors and, worse still, bank directors to assume that the regulators had everything under control. I have never forgotten sitting beside a man at a dinner in Washington in 1992, at the time of the World Bank IMF annual meetings, a man who had had a lifetime career in the British Treasury. And he had just stepped down from a very senior role in the British Treasury and become a director of one of the major UK clearing banks. I said to him, how do you find being a bank director after a lifetime in Her Majesty's Treasury? Ooh, he said, funny you should ask that question. Because he said, I've always thought that banking is about measuring and pricing risk. And of course, in the Treasury, I really haven't had to worry about that. He said, I was greatly relieved to discover when I joined the board of that major UK bank that all I had to worry about was, are we complying with the Bank of England's rules? I found that very disturbing. A few years later, in New Zealand, we adopted a new approach to banking supervision, as David Wilkinson mentioned, which relied on having very few rules and regulations at all, but having a requirement to have a very high level of disclosure by banks to the marketplace, and an attestation by bank directors every quarter that their bank had appropriate risk control systems in place for the nature of their banking business. When we announced this project in the mid-90s, the managing director of one of the largest banks in Australia, which had a big operation in New Zealand, came across the Tasman Sea and said, look, Don, you can't do that. I said, why not? He said, because most bank directors know absolutely nothing about banking. You cannot expect these guys to sign off these statements. I said, you want me, the bank regulator, to make the key risk decisions for your bank so that you can employ bank directors with big names to make your bank look good? I said, I'm not doing that. You need to make those decisions yourself and have bank directors who can do so. All these factors, in my view, played a part, because of course in most part of the world, bank regulators and bank supervisors did take over most of the key decisions which banks had to comply with. But I also want to argue that underlying the whole crisis was a profound imbalance in the global economy between China and the US that caused interest rates to be far too low for far too long in the US and some other advanced economies. As you probably know, Alan Greenspan and the Federal Reserve Board have been accused of holding policy interest rates too low in the early and middle part of the last decade, thus providing far too much encouragement for credit growth. He's replied that the interest rates which are most relevant to the home mortgage market are longer term rates, over which the Fed has only limited influence. What appears to have happened is that China kept its exchange rate at an artificially low level for several years in order to encourage exports. This had the direct effect of providing an abundant supply of cheap imports to the US, helping to keep inflation in check there directly, and justifying thereby low policy interest rates. It also had the effect of generating very large balance of payment surpluses in China, which China invested in US treasuries, thus tending to depress yields on longer term securities in the US. There was what in Europe would be called a Faustian bargain, which in many ways suited both the US and China, at least in the short term. The US got low consumer price inflation, low interest rates, rising asset prices, and inexpensive funding of its growing fiscal and current account deficits. China got open access to the world's largest market for its rapidly growing export industries which were able to employ the hundreds of millions of people moving from the countryside into China's rapidly burgeoning cities. But there's been a cost, as there is in every Faustian bargain. The bubble has popped in the US, and American homeowners and state and federal governments suddenly find themselves grappling with the consequences of binging on credit. There's resentment, rather than gratitude, for the flow of inexpensive imports from China, and frustration that China refuses to let its currency appreciate to reflect its vast foreign exchange reserves and huge balance of payment surplus. Chinese policy is seen as being a catalyst and aimed at generating employment in China at the expense of American workers. On the Chinese side, there's anger that the vast US dollar assets built up over many years are drifting down in value against the currencies of other countries, and irritation at the criticism which US politicians express about their currency regime. In my view, this serious imbalance between the US and China, caused by the substantial undervaluation of the yuan, is damaging China, damaging the US, and seriously damaging prospects for international trade and economic growth. It's damaging China because by keeping the cost of capital artificially low, it's leading to all sorts of wasteful investment. By keeping the cost of consumption artificially high in China, in other words, by keeping real wages artificially low, it's keeping domestic consumption below what might be expected in a more normal situation. It's estimated that private consumption makes up only about 30% of China's GDP, compared with 60 to 70% in most developed economies. And of course, this situation is channeling vast sums from China into low-yielding US treasuries. A country at China's stage of development might normally be expected to run a balance of payments deficit, with resources flowing into the country to add to its stock of investment capital. This was Singapore's experience in the early stages of its development, and of course also that of many other now developed economies such as Canada, the US, Australia, and New Zealand. It's extraordinary to see a country which, despite very rapid growth, is still one of the poorest countries in the world, exporting vast amounts of capital to the US. Undervaluation of the yuan is also damaging the US and other countries by dragging a great deal of manufacturing production out of those other countries towards China. And of course, the risk is that in the current environment of high unemployment, very low growth, and fiscal austerity in many developed countries, there will be strong political pressures to compensate for the undervaluation of the Chinese currency by some form of protection against Chinese exports. There's already intense pressure for the US Congress to impose duties on Chinese exports to the US, and that's become very much more evident in recent days. We all know how extremely dangerous such moves would be. There's some very tentative signs that China may be willing to allow the yuan to appreciate somewhat. In July, Hu Xiaolian, Deputy Governor of the People's Bank of China, gave a series of speeches in which she argued that a freer exchange rate